Peter Lynch, one of the most successful and well-known investors of all time, led the Magellan Fund at Fidelity Investments between 1977 and 1990, achieving an average annual return of 29.2%. Lynch's investment philosophy is straightforward yet profound, emphasizing that individual investors can exploit market opportunities by investing in what they know. Let's delve into Lynch's investing formula, highlighting key financial ratios and metrics that he suggests investors to consider. PE to growth PEG ratio. Lynch is famous for popularizing the PE to growth ratio, which adjusts the PE ratio for the company's earnings growth rate, providing a more nuanced view of a stock's valuation. He believed that a stock's PE ratio should be roughly equal to its growth rate, making the PEG ratio a central tenet of his investment decision-making process. For example, if a company has a PE ratio of 15 and its earnings are expected to grow at 15% annually, the PEG ratio would be 1/15 divided by 15, which Lynch might consider fairly valued. Debt to equity ratio. Lynch emphasized the importance of a company's debt levels. He preferred companies with low debt to equity ratios, as high debt levels can increase a company's risk, particularly in industries that are sensitive to economic cycles. For example, a company with a debt-to-equity ratio of 0.5 indicates that it uses 50 cents of debt for every dollar of equity, which is generally considered manageable. In contrast, a ratio of 2.0 might be seen as risky, indicating $2 of debt for every dollar of equity. Net cash position. Lynch often looked for companies with a strong net cash position, believing that cash provides companies with flexibility to invest in growth opportunities, reduce debt, or weather economic downturns. For example, a company with $1 billion in cash and cash equivalents and $500 million in debt would have a net cash position of $500 million, indicating a strong balance sheet. Inventory and receivables growth versus sales growth. Lynch warned against companies where inventory and receivables grow faster than sales, as this can indicate potential issues with product demand or collection problems. For example, if a company's sales are growing at 10% annually, but its inventories are growing at 20%, it might suggest that the company is overproducing or facing declining demand for its products. Operating margin. Improving or consistently high operating margins can be a sign of a company's efficiency and potential for profitability, an aspect Lynch valued highly. For example, a company that increases its operating margin from 10% to 15% over several years is likely finding ways to reduce costs or increase prices, enhancing its profitability. Free cash flow. Lynch appreciated companies that generate significant free cash flow, which is the cash that a company can produce after accounting for capital expenditures. It indicates a company's ability to repay debts, pay dividends, and fund growth. For example, a company generating $200 million in free cash flow is in a strong position to invest in new projects, buy back shares, or increase dividends, all of which can enhance shareholder value. So, Peter Lynch's investment philosophy is characterized by a blend of qualitative and quantitative analysis. By focusing on understandable businesses, looking for companies with solid growth prospects relative to their valuation as indicated by the PEG ratio, low debt, strong cash positions, efficient operations, and robust free cash flow, investors can apply Lynch's principles to identify potential investment opportunities. While the examples provided illustrate how to apply these metrics, investors should also consider the broader economic and industry context, as well as company-specific risks. Now let's analyze NVIDIA's stock using Peter Lynch's method. Price-to-earnings PE ratio. According to Lynch's philosophy, the PE ratio is a starting point for valuation. NVIDIA's PE is quite high, which could indicate the stock is overvalued or that investors expect high growth rates. PEG ratio. Lynch would likely consider NVIDIA's PEG ratio below 1 to be a positive indicator, suggesting that the stock could be undervalued given its growth rate. Debt to equity ratio. At 0.32, this ratio is within a reasonable range, suggesting NVIDIA does not have excessive debt relative to its equity, which would align with Lynch's preference for companies with manageable debt levels. Net cash position. With $7.48 billion net cash, NVIDIA has a strong net cash position, which would be seen positively by Lynch as it suggests financial flexibility and resilience. Inventory and receivables growth versus sales growth. Significant increase in revenue growth without a proportional increase in inventories and receivables would be a good sign for Lynch. Operating margin. NVIDIA has a high operating margin of 45.94%, which suggests efficiency and profitability, metrics Lynch would favor. Free cash flow. NVIDIA's strong free cash flow generation is a positive sign and would likely be attractive to Lynch, as it provides the company with opportunities for growth, dividend payments, and share buybacks. In conclusion, Peter Lynch would likely find NVIDIA Corporation's financials appealing, especially given the PEG ratio, which suggests growth at a reasonable price, and the company's strong net cash position and free cash flow. However, the high PE ratio could warrant caution and a deeper look into whether the growth expectations justify the valuation. It's also important to consider the context of the semiconductor industry, NVIDIA's competitive position, and broader market conditions.